Question 42. On July 1st, 2018, Truman Company acquired 70% interest in Atlanta Company in exchange for consideration of $720,000 in cash and equity securities. The remaining 30% of Atlanta's shares traded closely near average price that totaled 290%, both before and after Truman's acquisition. In reviewing this acquisition, Truman assigned a $100,000 fair value to a patent recently developed by Atlanta, even though it was not recorded within the financial record of the subsidiary. This patent is anticipated to have a remaining life of 5 years. The following financial information is available for these two companies for 2018. In addition, the subsidiary income was earned uniformly throughout the year. The subsidiary declared dividend quarterly. Okay, so before we solve the questions, let's use our step 1 to prepare an allocation schedule for the acquisition date subsidiary fair value. Okay, so in the step 1, so the first number we want to calculate is what is the controlling interest fair value, what is the fair value of the non-controlling interest, and both numbers are given directly by the question. Okay, so they're here. So for the 70% interest, it paid $720,000, and for the remaining 30%, is market value at 290. So both number is given, and combine them together, we get the total fair value for the subsidiary, that's $1,010,000. Okay, so next step is to calculate what is the total book value acquired. So in this question, because the financial information given here is the numbers at the end of 2018. So basically, but the acquisition happened in the middle of the year, that's on July 1st, 2018. So which means that we need to figure out what is the book value on that date. So instead of using the asset minus liability, we can use the balance of the subsidiary's equity account, which means that we can use common stock, additional paid-in capital, and its retained earnings. But the retained earnings here we are given are the beginning and ending. However, we need to know what is the balance of retained earnings on July the 1st. Okay, so here's how I calculate the book value. It equals to the common stock balance, 300,000, common stock, and plus 20,000 additional paid-in capital, and plus the beginning retained earnings, at the beginning of 2017, and plus the net income over the year minus dividends paid the year, and times 50%, and all divided by 2 because acquisition happened during half the year. So then this part gives us what's the change over the half the year for the retained earnings. So finally, we got the book value acquired is $840,000. Alright, so next is to calculate what is the excess amount of fair value over book value. It is $170,000 equals to the $1,010,000 minus $840,000. So next step is to allocate the excess amount to those accounts with different fair value from book value. And the one account we know is the patent. It's not recorded on the book, but it does have a market value is $100,000. And for this patent, it has 5-year remaining life, which means that every year there is $20,000 annual amortization expense. And for the remaining amount, we can allocate them to goodwill. We do not amortize goodwill. So the total excess annual amortization is $20,000 every year. Alright, so this is step 1. And then let's move on to have a look at the questions. Question A. Answer each of the following. A. how did Truman allocate Atlanta's acquisition date fair value to the various assets acquired and liability assumed in the combination? Okay, so actually we already prepared the schedule for question A. We have patent and we have goodwill. Okay, next question. How did Truman allocate goodwill from the acquisition across the controlling and non-controlling interest? Okay, so to solve this question, I'm going to use this table or this schedule to help you understand how to allocate goodwill when there is a controlling premium paid in the transaction. And first, let's see what is the fair value of the non-controlling and controlling interest on the acquisition date. As to the amount over here, actually we already calculated. There are these two numbers. 720 is the fair value of the controlling interest. 290 is the fair value of the non-controlling interest. I'll put them here. So the total is 1 million. $1,010,000. Okay, next is what is the relative fair value of the identifiable net asset. This part is a little bit tricky, and that's the relative fair value of identifiable asset. And the way we calculate that is we use total book value and plus the unrecorded patent. So that's going to give us the relative fair value of the identifiable net assets. In total, that is 940,000. And then because controlling interest have 70% of the controlling interest, so we need to allocate 70% of the total relative fair value to controlling interest, and equals to 658,000. And for the non-controlling interest, it's going to get 30% of that. Alright, that's 282,000. And to the goodwill, by definition, goodwill equals to the fair value acquired minus the relative fair value of the identifiable net asset assigned to them. So for the control interest, its goodwill, the allocated goodwill amount will be 720,000 minus 658,000. So 62,000 is the goodwill we can allocate to controlling interest, and 8,000 is the amount we allocated to non-controlling interest. And then the total goodwill we have here is 70,000. Question C. How did Truman derive the investment in Atlantic account balance at the end of 2018? Okay, so I prepared this schedule to show you how we get the balance of investment in Atlanta. So the ending balance of investment in Atlanta equals to the beginning balance, its beginning balance, and plus the net income, plus net income minus excess annual amortization and minus dividend. So in this question, we know the whole year net income, annual amortization, and dividend paid within the year. But we need to consider the acquisition happened in the middle of the year, which means that we have 2 times 50%. And also, the controlling interest only have 70% of controlling interest, so we also need to times 70%. Okay, so that's why we have 70% times 50% and times the annual net income. And we do the same for the excess annual amortization and for the annual dividend paid. And then we can get the annual balance for investment in Atlantic of 727,000 at the end of 2018. Okay, so that's the answer for question C. Question D. Prepare a worksheet to consolidate financial statement of these two companies as of December 31st, 2018. Okay, so before we can prepare a worksheet. Normally we need to prepare the consolidation entries. So here I'm just going to give you the entries, and after the entries prepared, then the worksheet is not hard to fill in. Okay, the first entry is to eliminate the subsidiaries equity account, which is entry S. But this question a little bit different from the question we have done before. Is this acquisition happened in the middle of the year, which means that we have to eliminate half year of revenue and expense and also dividend, because those are not belong to the combined entity. Okay, so in this entry, we debit common stock, addition paid in capital, and the beginning return earnings. So these three accounts are the account we normally debit in entry S. At the same time, we debit revenue and credit operating expense and credit dividend. And those are all the activities that happen in the first half of the year, and that's not belongs to the combined entity. All right, so after we have them prepared, then we need to we can get a net amount of debit balance, and then we are going to allocate 70% of that amount to investment Atlantic and 30% to non-controlling interest. Okay, so this is entry S. And as to entry A, so here we have we separate entry A to two parts. One part is to allocate the patent amount to investment Atlantic and non-controlling interest, and entry A2 to allocate the goodwill to the two accounts. So for patent, we are going to allocate 70% of patent fair value to investment account, investment Atlantic, and then 30% to non-controlling interest. Well, as to the goodwill, we cannot allocate 70% of that goodwill directly to, because in this transaction, the parent company paid a control premium in this transaction, which means that they paid more. So the investment, the amount we allocate to the investment is more than 70% of the total goodwill. And also we already prepared this allocation schedule for goodwill over here, right? So which means that for the goodwill allocated to controlling interest, it would be 62,000, and for the amount to non-controlling interest is 8,000. Okay, so that's the amount we have here as well. Okay, so that's entry A2. And we separate them is because we can allocate patent to this controlling and non-controlling interest based on the percentage. Well, for the goodwill, we cannot do that directly. We have to rely on the schedule we just prepared. All right, so that's entry A1 and A2, and that's something that's different from what we have done before. And the other part are the same as what we did we have done. So the next one is entry I. Entry I is to eliminate entity incomes. Okay, so for the income, we need to eliminate this income of the subsidiary, which is 35,000. Okay, so that's what we did here in entry S. Entry I, we debit income of subsidiary 35,000 and credit investment Atlantic 35,000. Well, next one is entry D. Entry D is to eliminate this inter-entity dividend paid, and it's 28,000. How we get 28,000? So 28,000 will be 70% of the half year total dividend. So that equals to 70% of half year dividend equals to 28,000. Okay, so that's how we get this 28,000. And last one is the amortization. The amortization expense, because this is only also for the half year. So because the annual amortization expense is 20,000. So for half year, that will be 10,000, which is entry E. Debit amortization expense and credit patent.